Hey everyone, welcome in to another daily editorial here on the KE Report. We're chatting with Jordan Roy-Byrne. We're going to be recapping what has happened in history during Fed rate cutting cycles since today, September 18th. We got a Fed rate cut, the first one of probably a series, and a 50 basis point rate cut. It was a toss up between 25 and 50 point basis, and well, the Fed went to the 50 basis point. We are seeing some pretty strong market reactions, including in the precious metals and even the underlying precious metals stocks. Jordan is the editor of the Daily Gold. We will post a link to his website below this interview. Jordan, let's look back in history then to other periods in time where the Fed started cutting rates, the type of market reactions we saw on the back of that. You recently sent out a note to your subscribers breaking down some of the more noteworthy market moves. Jordan, share with us what some of your research tells you about the potential of at least precious metals, where they go from here during rate cutting cycles.
Well, I remember in 2017, 2018, I was studying the history of the Fed cutting rates and how gold stocks performed. And in nearly every case, except I want to say one or two from the 70s, it was bullish for gold stocks. Like they had a really good move over the next year. So the data is not surprising. I could have gone back farther. I looked at the start of the last four cycles, rate cut cycles. We got 2019, 2007 in the summer, 2001 at the very beginning of the year, and then 1989. And gold stocks performed well in every case. The weakest move was actually the last one in 2019. They only had a 18% move in 1 month after the cut. And in part, I think that was because they had a big move leading up to that when, if you recall, May, I remember the gold stocks were down and sentiment was really poor. I don't want to say really bearish, but people just didn't care. They were despondent. And then the Fed indicated it was going to cut. So you got a huge move out of the May 2019 low. And so that's why the move after the cut was not as big as the other three. I mean, 2007, you had a 52% move in 2.5 months, 72% move in 5 months. 2001, you had a 41% move in 2 months, 87% in 4.5 months. And in 1989, you had a 51% move in 9 months. So when they cut rates, all things being equal, it tends to be bullish for the gold stocks. And we have a setup now where if you're looking at especially monthly and quarterly charts, like I think if you're looking at quarterly charts, gold stocks have already broken past that 2020 resistance. So if you're looking at quarterly candles, which I know most people never do, but we're already set up to close at the highest quarterly close for gold stocks in 11 and a half years or so. And so if you're looking at monthly candles, I don't know what the level is, but GDX is getting pretty close to that, where right now it's in position for the second highest monthly close in 11 and a half years. So if you're looking at the current setup, like the current technicals, like we're on the cusp of a significant breakout in the gold stock. So this could be, it's hard to predict the future, but at the end of the year, we could look back and say, oh yeah, well, that was when the Fed cut rates, and that's when we got the next leg higher in precious metals.
Well, Jordan, just to that point, since this Fed rate cutting cycle has been so telegraphed to the market, maybe one of the most telegraphed rate cutting cycles, because a lot of the other ones, like you say, that 2019 one kind of was a surprise where they reversed they originally were going to hike and then they decided to cut instead. That was a big surprise, and that's why it gapped up so much before even the cuts started. In this case, the cuts are starting where the gold price has moved up to all-time highs. Is it more of a catch-up trade in the miners where they'll still see those 30 to 50% moves, or do you think some of this is already actually priced in?
Yeah, it's a really good question. But if we're looking at the miners, if we're looking at the action since May, you could make a case that the price action since May is a running correction in the miners. So if you look at GDX and you look at, they had a peak in the middle of May at right around 37, and then they made a low just a week ago or so, right above 36. So that could be a running correction. And if you're looking at GDXJ or even SILJ, like it's pretty clear you can make the case, well, since May, like this has been a correction. Like it's been a consolidation. It's been a upward consolidation, which kind of aligns with my theory that this is a running correction in the sector, and a running correction could give way to a really significant move higher. But to answer your question directly, the miners have not done anything basically since May. Again, if you're looking at GDXJ in May, it had this peak at about 46. A couple weeks ago, it was at 42. Before today it hit a low of just in the high 47s. So same thing with SILJ. You had this peak in May at about 13. Today you had a low of 12 and a half. So generally speaking, you had almost 5 months of the miners not really making any progress. So, I mean, based on that, I don't know that we can say that they've already discounted this move by the Fed.
Jordan, what about comparing what you think is going to happen here to, let's say, the precious metal stocks? Fine, they could be in for another run. What about the U.S. equity markets? We've heard from some people that rate cutting cycles, not necessarily good for U.S. markets. Is now the time, finally, when the gold stocks completely outperform the markets?
Yeah, I kind of sense, regardless of what the stock market does, I think this next leg higher, assuming we get a leg higher in precious metals, I think this is the leg higher where you can start to see precious metals really outperform the stock market. If you look at the Huey against the S&P 500, I mean, that's broken out. Gold is not quite there yet, so it's an interesting call because we want to see gold break above 0.50 against the S&P, and it's probably at 0.47 right now. But gold could get to 3,000 before it actually makes that breakout move. But that aside, I do tend to think that this is the leg where we're going to see capital start to rotate into precious metals, even if you get some more strength in the stock market. How the stock market performs based on the rate cut, I mean, it's all dependent on the economy. I mean, it's easy for people to say, and I probably said it as well. Well, whenever they cut rates, usually that's when the market peaks around that time. That's definitely true, but there's also some cases where when the economy was in a soft landing, the market kept going higher. So there's that scenario. But I think in the very short term, like the next couple months, I could see the equity market rallying because in some of these cases, they cut rates and then you had a rally for a little while before the economy actually petered out. Like it wasn't instantaneous.
All right, well, we'll keep tabs on how the U.S. equity markets respond to this rate cutting cycle, but it does seem like regardless what happens, you're still looking at the gold stocks to outperform. Let's bring silver into the equation. Silver's had a nice pop today too, back over 31. It's kind of not had the same chart jubilation that the gold chart has, but it is starting to catch up. Do you think silver can be the dark horse coming from behind and really start to play catch up here?
It's definitely possible. Definitely possible. I mean, if this move really catches fire, then yes. I really like the action in silver on the weekly chart. If you look at a weekly line chart and smooth out the volatility, it did a really good job of holding above the resistance from 2020 to 21, those 2 or 3 peaks. Same thing on the monthly chart. Like I really like how the monthly chart is setting up here in silver, where it held above that resistance multiple times, even though during the last 3 months prior to this month, it was trading down below that support, but every month it recovered and closed above it. Short term 32 is resistance on the daily and weekly charts. So if you break above 32, you can see a bit of a run. And if we're looking at monthly and quarterly charts, 34, 35, that area is pretty strong resistance. So, I mean, if we are to see like a monthly or quarterly close above 34, 35, if you get a monthly close, like in the next couple months, you get a monthly close at 36 or 37, that could put silver in position to run higher than that. Looking at the quarterly closes, I'd have to take another look, but I don't think, well, I guess we have a couple weeks left. It's around 33, 34, somewhere in there. Just cautiously saying, I don't think we can close above that this month. But again, if we get quarterly and monthly closes that are above the 34, 35, that could put silver in position to run to 50. Like if in the next couple months, if we get those types of closes, then you don't have any resistance. And so that could put silver in position to run to 50 before you get some kind of bigger correction. So there's definitely potential here if this move really catches fire for silver to run up to 50 in the next 12 months. Based on my analog, looking at the four best silver bulls, I think the average of the four best would put silver at 45 about 13 months from now. So if you're thinking about 50 as a target by the end of next year, even in 12 months, like that's not that much out of step with a real bull market in precious metals.
Let's talk silver miners then too. Can you pull up that SIL chart, the silver miners ETF? Because last week was a huge week for the SIL. It was up over 16%, put in a couple daily gaps as it just exploded higher. And now it's very close to at least touching those recent highs from July of 36.75. It's just below there. How important would it be for SIL to get above that 36.75 level, that high from this year?
I really like the price action in SIL and SILJ. Like they're just nice bullish consolidations. And if you look at SIL, there's really strong resistance at 50. So if you see SIL take out 35, 36, it could possibly run to 50. I don't know in what time frame. Same thing with SILJ. Like that big resistance is, I want to say like 18, 19, like going back to 2013. I mean, you have the 2016 and 2021 peaks. And again, you have a bullish consolidation in SILJ. So breaking above 13, there's some room where it can run. So based on what I said about silver itself, and then you're looking at the charts in the silver stock ETFs, there's definitely some potential where, I mean, again, if we're looking at silver, 34, 35 looks like, you never want to say certainty, but it looks like that's very likely to happen. And you think about what I said before, and if silver could make a monthly or quarterly close above that resistance, like it could, that, and if the market really catches fire, silver could make a run to 50 in the next 12, 13, 14, 15 months. And so you would obviously have big moves in SIL and SILJ. And looking right now at the recent price action, they're about to come out of bullish consolidations. So I think silver stocks can do really well here over the next year or 15 months.
Well, Jordan, just following up on the silver stocks, we talk a lot about the gold stocks, but if silver could make that move, even just to 34 or 35, the producers would uniformly be making money. And I know a lot of them are polymetallic, but they report in silver equivalent ounces. And there are some companies that have a lot of silver exposure. Would you be more interested in positioning in those, some of the silver producers? Or we've talked in the past about the optionality of development projects. Which one do you think would be maybe something for the next 12 months to consider, the producers or the optionality in silver stocks?
It's all company specific. The problem with many silver producers is they're just low quality. Like, let me take a step back for a second. The health of the silver sector as a whole, this was in a much stronger position, I think, in the early to mid 2000s. So coming out, even at the 2008 bottom, you still had like you had a handful of quality, like really quality junior producers at that point. And there's been so much carnage in just junior mining in general because we've gone through this secular bear market. You could say 2011 to early earlier this year or late last year. I mean, that's over a decade. And you look at the silver price, I mean, it's way off its all-time high, even the 2011 high, and even more than that in inflation adjusted terms. So what I'm getting at is that has really devastated the whole silver industry. So the better silver companies have gone into gold. So a lot of these silver producers, like they're just not high quality. Like they have small mines, they don't have long reserve lives. So there's not a lot of quality there. And for that reason, a silver optionality play, like if they have silver in the ground and it's actually silver and it's not silver equivalent. I mean, not to go off on a tangent, but like a lot of these companies who say they're like they're not silver companies. They're base metals. They have base metals projects that are masquerading as silver projects. So my diatribe aside, I guess the takeaway is the junior silver sector itself is not as far as the quality of the companies is lower than it was 15, 20 years ago. That makes it difficult. And you have to look at everything on a company by company basis. But if you're looking at a producer, growth is what you want to see, production growth. And if you're looking at optionality, silver ounces is what you want to see. And second, gold ounces. So silver ounces and gold ounces. The silver equivalent stuff is the market doesn't like that as much. But the sector is so tiny that if we have this big run in the next 12 or 15 months, there's low quality stuff that could 5x or 10x in a year just because people get really excited. There's lots of pumpers around that have big audiences, and they could really pump these stocks up. So I know this is not the clearest explanation, but for all those reasons, it really has to be company dependent. But production growth, ounces in the ground, to me, that's the top two criteria here.
So, Jordan, tugging on that string a little bit, are we potentially in the setup where everything rises? Are we in that bullish, euphoric phase where even the crappiest juniors go up?
Well, I would say the crappiest juniors that have pounds or ounces in the ground. As far as exploration, which is the last to move, possible they could start to move. I don't know if they're truly going to lead here, but I could be wrong. But all that being said, Corey, I would still lean towards quality. I think higher quality stuff is still going to lead this for the time being, and that you can have the most upside in that and the most certainty that it's going to perform well. I mean, take the doubles and triples out there. You don't necessarily need to swing away for home runs. Like if you're going to do that, just be very selective, be very specific. Don't just look for random silver. Don't put your money in like 10 random silver juniors. Like that's not the thing to do.
Jordan, I'm so with you right now. This is a market where, look, you can still make money off the highest quality companies. Maybe you won't get that 10x return, but you're going to limit some of your losses. In this market, as I guess, as much as some stocks have run and how some stocks are at 52-week highs, fact of the matter is, I'm with you. I think right now, stick to the quality. And again, you might not get those 10x moves, but you're going to have safety. So, Jordan, how about you elaborate on that then? The whole aspect of sticking to quality rather than getting distracted by the junior stocks, even if everything is going to run higher.
Yeah, Corey. And by quality, I'm not necessarily talking about something like Wheaton Precious Metals, although that is a very high quality company. I'm talking about the juniors that have quality management and a quality project that has significant value and at the same time leverage to upside in a bull market. So and what I'm really trying to do is, okay, what's the upside potential and what's the quality, and then kind of merge those two together. So again, I'm not necessarily looking for wheat and precious metals, but at the same time, I'm not looking for something that's like bottom of the barrel that has 300 million ounces. I'm looking for juniors that have the quality management, quality assets, and at the same time, they have significant upside potential. So that's what it comes down to for me. We're trying to mix and match what's the quality of the asset in the company, what's the value proposition, and then what is the upside potential that it has. So that's what I'm really looking for. So you're not necessarily looking for the blue chip companies in the space. You're looking for the juniors that are of the highest quality or near highest quality that have the most upside at the same time, because those companies, they are going to rise and do really well versus I'm not looking at something that's lower quality than that or low quality that I think can 20x or 50x. That's too much of a gamble. You want to go with the stuff that's more of a certainty that does have significant upside.
That's the thing, right? Those are still good returns. Stick to some of those returns and limit your losses because, look, if we do get into this environment where everything's going up, I know it gets enticing to go into some of these micro cap companies, but still, some of the best companies out there are generally small and still have room to run. But hey, we'll see how it all plays out. Hey, Jordan, at least it's moving in the right direction and has been now for a number of months. Even the corrections have been relatively shallow and come back to really just the first stopping points and bounce from there. Jordan, again, is the editor of the Daily Gold. Click that link in the show notes to follow along with them. Jordan, thanks for your time.